Welcome to The Deep Dive, the only show that takes your stack of sources and maps the entire intellectual territory for you.
Today we are tackling something massive.
I mean, truly massive. We are tracing humanity's single most enduring, complicated, and, surprisingly fragile idea, the concept of value itself.
It's an incredibly ambitious timeline. We're spanning thousands of years, but it's absolutely necessary if you want to understand wealth today. Because when we talk about money, we tend to fixate on the object.
Right, the gold coin, the paper bill, or you look at your phone and see the fluctuating Bitcoin price.
Exactly. But those are just surface representations. They're just tokens. Our mission today is to dig into what our sources lay out as the 4 essential stages of currency evolution. We're going from primitive exchange right up to decentralized digital networks to see what that invisible ingredient is that truly holds it all together.
Okay, so let's just jump right in with a question, a provocative one that really drives this whole deep dive.
Let's do it.
If you stripped away all the history and all the context, what is the actual fundamental difference between a piece of standardized gold, a rare clamshell from the Indian Ocean, a paper bill issued by the Federal Reserve, and a cryptographically secured hash on a global network?
And the shocking, unifying answer, which is reinforced by every single historical shift in our source material, is that the true value of all those things relies on the same fragile, invisible foundation.
Which is?
Collective belief and trust. That's it. The foreign changes. It moves from tangible things to government decree to immutable code. But that core requirement for a shared collective agreement on worth is absolutely constant.
Exactly. So today we're moving from the struggles of physical exchange in ancient times through the rise and fall of standards backed by tangible assets like metal, all the way to the modern age of digital scarcity. We're going to show you how every single era's definition of money, what makes it valuable, has fundamentally shaped society, technology, and, of course, power structures.
And this analysis is drawn from a really varied stack of sources. This isn't just one history book. We've synthesized findings from historical accounts detailing Chinese and Roman currency evolution, some highly technical academic models that show how financial trust just evaporates during crises, and detailed technical material on the fundamentals of blockchain and this paradox of digital scarcity.
Okay, this is where it gets really interesting. Let's start at the absolute base layer, the time before money, and transition right into humanity's earliest and most logical attempt at solving the problem of exchange.
We have to begin with the flaw of pure barter. It's more than just a flaw, really, it's a bottleneck. As soon as societies advance beyond, say, subsistence farming, you get specialization.
The sandal maker, the armorer, the spice trader.
Right. And barter is inherently crippled by what economists call the double coincidence of wants.
We hear that term a lot, but let's break it down in practical terms for everyone listening. This isn't just an academic term for being frustrated. It's a systemic obstacle to any kind of growth, isn't it?
Precisely. It's a total break on the economy. So if you're the sandal maker and you have shoes and you need grain, you don't just need a farmer who has extra grain.
You need a farmer who, at that exact moment, happens to need a new pair of sandals.
And not just any sandals. Sandals of your specific quality and in his size. If that farmer needs, a new plowshare or some medical supplies instead, the exchange completely fails. The transaction costs, just the time and the effort you spend searching for that perfect counterparty, they just quickly make a complex, specialized economy totally impossible to sustain.
So the solution wasn't to get better at bartering. That was never going to work. The solution was to invent a medium that everyone universally agreed was desirable.
And durable and portable. They were searching for an anchor, something tangible that would eliminate that wants bottleneck.
Universal medium of exchange.
That is the key evolutionary leap. And one of the most compelling case studies we have for this transition, from just naturally rare goods to institutionalized money, comes from ancient China. Specifically, the use of the cowrie shell during the Shang dynasty, which goes back 3,000-4,000 years.
A clamshell as the basis for the first widely accepted currency.
Oh.
That is fascinating. It just feels like the complete antithesis of a modern digital asset,
It does, but it fulfilled the necessary criteria perfectly for that era. They were sourced from the warm waters of the Indian Ocean and the South China Sea, which made them intrinsically rare in the central plains of China. They were durable, they were easily counted, they were recognized, and they were highly portable.
So they checked all the boxes.
All of them. And their usage was so foundational to the economy, to the social structure, that the traditional Chinese characters for fundamental concepts like goods, buy, sell, wealth, exchange, they all contain the radical for shell.
Wow. So it's like a linguistic fossil proving how important they were.
It's baked right into the language. But of course, the moment the economy grew, that natural supply chain of shells must have failed them. You can't just find more shells on command.
There's only so many you can pull out of the ocean.
Exactly. And our sources detail this crucial moment of monetary institutionalization. Because there wasn't enough organic supply to support a growing specialized economy, the Chinese began manufacturing imitations.
Imitations?
Yes. Out of bone, stone, jade, and critically, out of copper. Now think about the profound conceptual shift happening here. You're moving from using a natural, rare object to using a standardized, manufactured representation of that object.
That move from natural scarcity to manufactured scarcity, that is the true intellectual birth of money. The agreement to accept a representation of value, regardless of what it's actually made of, is born right there.
Precisely. The state wasn't just facilitating trade anymore, they were implicitly setting the standard of value. And this impulse to standardize just explodes in the ancient Mediterranean world. The shift from using, raw lumps of metal, which you'd have to weigh and test for purity every single time.
Which must have been a huge pain.
A massive pain. The shift from that to standardized marked coins was tectonic. It changed everything.
And the Lydians were the pioneers here, right?
Yes. The Lydians, located in what is now modern Turkey, were the first known people to strike coins around 610 BCE. They used standardized weights of electrum, which is a naturally occurring alloy of gold and silver. But the critical innovation wasn't the metal itself.
It was the stamp.
It was the stamp. The stamping of the royal symbol served as a government guarantee of weight and purity. This instantly reduced transaction friction and created immediate trust. You no longer had to test the metal, you just had to trust the king's seal.
And this provided a level of stability and scale that was completely unprecedented, which, as we see throughout history, is absolutely essential for building and maintaining an empire.
It is essential. Empires like Rome fully leveraged standardized coinage. You had coins like the silver denarius and later the pure gold aureus. This consistency was Rome's economic glue. It made inter-city trade possible across their vast territories, from Britain all the way to Egypt. It allowed the government to project centralized economic power and to pay massive armies and a huge bureaucracy in a predictable, stable medium.
But those gold and silver standards, they eventually started to crack under the strain of imperial ambition. Our sources point out the critical weakness here, the temptation of the state itself.
And that's the irony of commodity-backed money, isn't it? Its value is anchored in its physical purity, but the governing authority that guarantees that purity is also the one authority that can secretly reduce it. Our sources provide chilling detail on the Roman practice of debasement.
Can you elaborate on the scale of that debasement? Because it wasn't just a minor tweak here and there, was it?
No, it was catastrophic over time. Let's take the denarius. By the reign of Augustus, it was nearly 100% silver. Nero began the slow process of reduction, bringing it down just a little bit. But the practice accelerated dramatically during the crises of the 3rd century. Emperors like Elagabalus and Gordian, they were desperate to pay for armies and fund failing military campaigns without raising taxes.
So they just reduced the silver content?
They just started mixing in cheaper metals. So the coin still had its nominal face value, but its intrinsic value absolutely plummeted.
So what did you get down to?
By the reign of Gallienus in the mid-3rd century, the denarius was often less than 5% silver. Sometimes it was just bronze with a thin silver plating, what we call bilan. The Roman government was essentially creating money out of thin air by forcing the population to accept these debased coins at their old value.
And the result was predictable, I imagine.
Massive inflation, economic instability, hoarding of the actual precious metals. The good coins disappeared. And ultimately, a complete breakdown of trust in the imperial currency, which greatly contributed to the empire's internal chaos. It points to the ultimate limitation of commodity-backed currency, the temptation of the state to cheat its own population.
So humanity's first two great systems of value failed. Barter was too physically restrictive, and metal standards were politically too tempting. This leads us to the surprising shift toward paper money, which is maybe the greatest fiduciary leap of all. And once again, the origin story is China.
It is a remarkable historical detour. Paper currency emerged in China over a millennium before Europe widely adopted it. The Tang dynasty introduced an early prototype called flying cash, or fakian, as early promissory notes around the 9th century.
Flying cash. Why that name?
Because of the massive logistical challenges of moving wealth. Imagine trying to transport tons of heavy copper coin between the capital and distant industrial and trading centers, like the highly productive Sichuan province.
It would be incredibly risky and just cumbersome.
Exactly. Fakian were basically bank drafts. They were issued in one city and could be redeemed in another. So they weren't currency yet, not really. They were a secure, lightweight mechanism to speed up large-scale trade.
So they were mitigating the risk of robbery and just the sheer physical burden of metal. A paper note is much easier to carry around than literal tons of copper.
Right, and it was the Song dynasty in the 12th century that took the critical next step with the jiaozi, which was the world's first true government-issued paper currency.
And did it work?
Well, initially the jiaozi was backed by metal reserves, but they ran immediately into the issue that haunts every single paper currency system since inflation. It came from government mismanagement, specifically overprinting and not having enough metal backing.
The ultimate control mechanism, the finite nature of the metal, was gone. Now the government had the printing press, and that control proved way too tempting.
And this accelerates us to the definitive historical case study, the world's first truly fiat system. This was implemented by the Mongol-founded Yuan dynasty, which introduced the jiukao. This was a unified national paper currency that was explicitly not backed by gold or silver.
So they just declared it had value by decree.
Exactly. The Yuan government even decreed the death penalty for using precious metals in transactions, forcing the population to rely entirely on the state-issued paper.
They were betting everything on the government's stability and its word. And, as history shows us, that system failed spectacularly because of undisciplined printing and runaway inflation.
It provides the perfect lens for examining the fatal flaw of fiat money. This is often illustrated by the collapse of the Song dynasty, which happened before the yuan, but the principle of the printing press acting as a resource curse is so much clearer here.
How so?
Our sources use a powerful metaphor from historians. The ability to print unbacked money acted like a resource curse for the government.
That term, resource curse, we usually hear that applied to countries that find massive oil or mineral deposits. And as a result, they neglect developing other industries or collecting taxes effectively.
It's the exact same dynamic. For the Song government, the printing press provided what seemed like an endless source of revenue. They no longer needed to maintain the difficult, often unpopular process of efficient tax revenue collection. This independence allowed them to fund economically destructive policies without any immediate fiscal consequence.
So what were these specific economically destructive policies that the printing press sustained? I mean, the detail really makes the analogy concrete.
The ability to print money allowed the government to just ignore the natural feedback mechanism of the market and pursue policies that otherwise would have caused an immediate financial collapse. For instance, the infamous reforms instituted by Prime Minister Wang Anshi.
What did those involve?
They included nationalizing key industries, implementing complex and often corrupt price controls, and engaging in large-scale, very expensive military campaigns against northern rivals like the Jurchen.
Wars, nationalization, and price controls. I mean, these are policies that actively destroy economic output, and they were sustained by essentially just printing money to pay for it all.
Exactly. The sources argue this capacity created a disease of the heart for the economy. The government was functionally insolvent, but it could keep the lights on and the armies paid by injecting this unbacked currency. This led, inevitably, to hyperinflation, a flight from the currency into real goods, widespread corruption, and popular unrest.
So when the Jurchen and later the Mongols came knocking,
They found this advanced empire that was internally rotten, leading to its conquest by numerically weaker rivals.
that is profound. It suggests that a constraint, like a gold standard, isn't just an economic limitation, it's a necessary political check on the power of the state. Fiat money, when it's abused, it just removes that accountability.
It creates a very dangerous independence. When a government has to rely on tax revenue, it has a symbiotic incentive to ensure the private economy is thriving. When it can just print its own funds, that crucial accountability loop weakens dramatically.
Okay, fast forwarding several centuries, the rest of the world caught up to paper money, but they always tried to maintain some kind of physical link back to that tangible anchor, to prevent the kind of collapse that we saw in ancient China.
And that brings us to the global shift after World War II. The world stabilized under the Bretton Woods system in 1944. The US dollar was pegged to a fixed rate of gold conversion, specifically $35 per ounce, and other major global currencies were, in turn, pegged to the US dollar.
So it created enormous stability for international trade and growth.
It did, but the constraint of gold was still the ultimate anchor, and it resided in the vaults of the US government.
But the global economy grew so rapidly in the 50s and 60s, and that put immense strain on that anchor. The U.S. was fighting the Vietnam War and funding massive domestic social programs at the same time.
Precisely. This led to a significant deterioration in the U.S. balance of payments. Put simply, there were just too many dollars circulating globally relative to the U.S. gold reserves. Foreign central banks began to question whether the U.S. could actually maintain its promise to redeem dollars for gold at that fixed rate. The pressure was enormous, especially from countries like France, which explicitly demanded conversion of their dollar holdings into physical gold in the late 1960s.
So the U.S. was basically experiencing a slow-motion run on its gold reserves.
Yes. And the pivotal moment arrived in August 1971 when the Nixon administration unilaterally paused the dollar's convertibility to gold. It's known as the Nixon shock.
And it was meant to be temporary, right?
It was intended as a temporary measure to protect reserves and stabilize the situation, but it quickly became permanent.
So the U.S. effectively just cut the cord, severing the last meaningful link between a major global currency and a physical commodity.
And by 1976, the International Monetary Fund officially recognized the change. The global system shifted entirely to free-floating fiat currencies. The system we have today relies entirely on the perceived value upheld by governments and central banks, completely free from the constraint of physical gold reserves. It is the ultimate expression of value by decree.
And once we moved to a system based purely on perception and decree, trust became not just important, but the single ultimate non-negotiable commodity. I love the etymology here. The word credit literally comes from the Latin credere, which means to trust.
It's a perfect linguistic anchor for this idea. Modern finance is a highly optimized global coordination game built entirely on reciprocal belief. But the fragility of this belief system is immense, and what happens when that trust just vanishes? We don't have to look back to the collapse of the Yuan dynasty. We can look at the 2007-2008 global financial crisis.
That crisis was just a massive, sudden breakdown of faith in the entire system.
It was triggered by bad news revelations of significant losses on U.S. subprime mortgages, these toxic assets that nobody could properly value. And this led to an immediate, profound credit freeze in interbank money markets. Banks, who routinely lend each other billions overnight, suddenly just stopped dealing with each other, even with institutions they'd trusted for decades.
The moment the soundness of one bank was questioned, everyone started questioning everyone else's ability to pay back their debt.
And that's where the distinction between two types of uncertainty becomes so critical for understanding financial panics. There is structural uncertainty, which is doubt about the actual soundness of a bank's balance sheet, its fundamentals.
But that's not the real killer.
No. The more potent crisis-driving force is strategic uncertainty. That's the fear about what other participants are going to do.
So the fear of the bank run is actually worse than the bank run itself. If I think my neighbor's going to pull his money out, I better pull mine out first, regardless of what I know about the bank's actual health. The fear becomes self-fulfilling.
That's exactly right. You pull your short-term loan, you foreclose on your credit line to protect yourself, which then forces your counterparty into liquidity trouble, which then just ripples out across the entire network. Our sources provide a stark, quantifiable data point for this evaporation of trust. The sudden spike in the one-month U.S. LIBOR rates.
Okay, explain that metric to us because it sounds highly technical, but you're suggesting it's the most precise measure of a trust failure.
It really is. The LIBOR-I spread measures the difference between the actual rate banks charge each other for short-term unsecured loans, that's LIBOR, and the expected risk-free rate, which is OIS. Normally, that spread is tiny, maybe 10 basis points, because banks implicitly trust each other. The spread is the risk premium. It is the direct cost of not knowing if your counterparty is sound.
So if that spread widens, it means banks are charging a much higher premium to lend, which reflects their profound lack of trust in their counterparty's ability to repay.
Exactly. Before the crisis, that premium was negligible. By September 2007, it had hit 100 basis points. Following the collapse of major investment banks like Lehman Brothers in 2008, the premium rose to over 300 basis points.
That's a more than 30-fold increase.
More than 30-fold from pre-crisis levels. That rapid spike is a precise, unambiguous measurement of trust completely dissolving in the interbank market.
30-fold. That's not just institutionalized fear. That's pure system-wide strategic panic being priced directly into the lending rates.
And this leads us to the crucial academic finding known as the hysteresis problem in financial modeling. This is a key concept for you to understand because it explains why these crises are so hard to fix.
Hysteresis.
Financial models show that the transition between a good equilibrium, which is a dense, high-trust network, and a bad equilibrium, a sparse, low-trust network, is sharp. Once a crisis tips the system into that low-trust state, the recovery is disproportionately difficult.
Hysteresis. It means the path back isn't the reverse of the path out. Can you translate the findings of the model, specifically those parameters, I think they were B0 and C, into plain language for us?
Certainly. Think of hysteresis like a magnetic door latch or a very stiff spring. You only need a little bit of force to push it open to lose trust, but you need a much greater sustained force to push it back and make it stick again, to restore that trust. The models confirm that restoring trust requires two massive interventions from central authorities.
And those interventions are represented by B0 and C.
Yes. B0 represents the level of emergency liquid assets the central bank has to flood the system with. So think of this as quantitative easing or emergency bailout funds. It's the central bank stepping in to become the counterparty of last resort, guaranteeing liquidity when private banks won't lend to each other.
So B0 is a massive, unprecedented monetary injection.
Precisely. And C represents the required reduction in the cost of miscoordination, which is primarily achieved by drastically lowering interest rates. Lowering rates makes the penalty for taking a risk smaller, which encourages banks to start lending again because the cost of sitting on cash becomes higher than the perceived risk of lending it out.
So the models show that these parameters, massive emergency liquidity and near zero interest rates, have to shift well beyond the initial tipping point that caused the failure in the first place. And they often have to persist for a very long time, which is exactly what we saw after 2008. The recovery effort has to be dramatically larger than the initial destabilizing event.
That's the key takeaway. The enduring long-term nature of historically low interest rates and high liquidity support systems post-2008 really emphasizes that hysteresis is a fundamental, expensive feature of trust in complex financial networks. Regaining faith is much, much harder than shattering it.
So we have journeyed from barter, which failed due to physical restriction, to gold, which failed due to government temptation, to fiat, which is constantly threatened by this evaporation of trust and the hysteresis problem. Now we enter the digital age, where the newest attempt to define value and establish trust relies entirely on mathematics and code. Let's talk about the blockchain.
Blockchain is often misunderstood as just being Bitcoin, but it's fundamentally a revolutionary tool for solving the trust problem by removing the need for trust itself. At its core, it's a distributed ledger.
Right, a shared notebook.
A shared notebook, exactly. It's a growing list of records called blocks that are securely linked via cryptographic hashes, and it's managed by a peer-to-peer computer network.
So it's a chain of digital receipts, secured not by a bank's vault or a government's decree, but by, unbreakable math.
Correct. When a block of transactions is finalized, a unique cryptographic hash, a digital fingerprint, is generated, and this hash is included in the next block. This creates an unbroken, tamper-proof chain all the way back to the very first block. Changing data in one block retroactively requires altering all subsequent blocks and achieving network consensus to accept those changes, which is practically and computationally impossible on a large public secure chain.
And the innovation we credit to the person or group known as Satoshi Nakamoto in 2008 was solving the notorious double spending problem for the first time without a central bank.
This was the holy grail of digital currency. The double spending problem is basically this. How do you ensure that a single digital token isn't copied and spent multiple times, given that digital information is inherently easy to copy?
Right.
Bitcoin solved this using its blockchain consensus protocol proof of work. By requiring massive computation to validate and append a block, you ensure that the network agrees on one single legitimate history of transactions. This makes any attempt to double spend immediately visible and rejected by the network.
So the value of Bitcoin, much like those ancient cowrie shells, is derived from scarcity. But this scarcity is completely manufactured, or rather, it's engineered.
That is the core feature that separates it from government-issued fiat. Bitcoin has an engineered scarcity, a fixed cap of 21 million coins, enforced by the protocol's code. This is a perfect mathematical limitation immune to the political temptation of overprinting that doomed the Song dynasty's paper money and led to Roman debasement.
But the technology itself comes with immense, very real-world trade-offs, doesn't it? Especially around processing speed and energy consumption, particularly with that original proof-of-work model.
The trade-offs are significant, absolutely. The concept of block time illustrates the speed issue. Bitcoin averages around 10 minutes to generate one block. You contrast that with modern payment rails, which are instantaneous, or even Ethereum, which targets about 14 to 15 seconds. This inherent slowness is a direct consequence of proof-of-work security mechanism.
And the energy problem became a major systemic vulnerability.
It did. The sources confirm that proof-of-work consumes such staggering amounts of electricity, often more than entire medium-sized nations, just to secure the network. And that prompted a massive response. The entire energy expenditure became a vulnerability that threatened the technology's wider adoption and its reputation.
And that environmental cost pushed the development of alternatives, most notably the shift to proof of stake.
Yes. The proof-of-stake, or POS model, removes the need for enormous computational power for security. So instead of miners competing to solve complex math puzzles, validators stake. They lock up their existing currency to participate in block validation. If they try to cheat, they lose their stake. The threat of financial loss replaces the need for massive electricity use.
And the Ethereum merge in 2022 is the perfect case study here, showing a systemic response to a major vulnerability.
Absolutely. Ethereum successfully converted from proof-of-work to proof-of-stake, and it resulted in an estimated 99.95% reduction in energy consumption. This transformation demonstrated that a major decentralized network could adapt its consensus mechanism to address environmental and scalability concerns, proving that even these engineered scarcity systems are subject to continuous evolution and market demands.
So on one hand, blockchain provides a way to engineer perfect, verifiable scarcity for currency, giving us digital gold. But when we look at digital goods in general, software, art, media, we face an even stranger truth: the paradox of scarcity in the digital economy.
And this is a profound shift from the entire history we just covered. In the digital realm, goods are non-rivalrous and infinitely replicable. If you buy a physical record, I can't listen to it at the same time. That's rivalrous. But if I copy a software application, the cost is essentially zero. In theory, digital capability should render scarcity obsolete.
But economic value requires limitation. So markets have become masters at inventing scarcity where none naturally exists.
That manufactured limitation is created through several sophisticated mechanisms. One is planned scarcity, which is heavily leveraged by the video game and collectibles industries. The sources point to Nintendo's 2020 release of Super Mario 3D All-Stars. The game was deliberately time-limited, with sales restricted to a 6-month window.
A completely artificial deadline driving consumer urgency. You're buying it not because the supply is physically limited, but because the publisher has just decreed that the access window is going to close.
Exactly. This scarcity drives up the perceived future value and generates massive short-term revenue purely based on manufactured urgency. It proves that the psychological contract of scarcity is just as strong digitally as it was with cowrie shells. Another crucial mechanism is access scarcity. This is enforced by complex technologies like digital rights management, or DRM, and subscription models. DRM is the legal and technical architecture that restricts the copying or modification of files, thereby mimicking the exclusivity of physical goods.
And the shift to subscription models like Adobe's Creative Cloud or Microsoft 365 monetizes access rather than ownership.
Correct. And this is a profound business model change. You no longer buy a perpetual license for the software. You are renting continuous access. If you stop paying, the software often stops working. The scarcity is imposed through a continuous toll, transforming a non-rivalrous good, the software, into a restricted service.
And this is where the blockchain steps back into the picture, giving us the most radical form of manufactured scarcity yet: NFTs.
Non-fungible tokens are the culmination of this drive for artificial scarcity. NFTs are unique digital assets authenticated via blockchain, which guarantee the provenance and ownership of a digital file that is otherwise infinitely copyable.
So the JPEG file or the MP4 tile isn't scarce at all, but the ledger entry, certifying that you own the original or the certificated copy, is what holds the value.
Precisely. The famous example is the artist Beeple's work, Every Days, the first 5,000 days, which sold for $69 million. Anyone can view that image online, but the buyer acquired the NFT, which was authenticated on the Ethereum blockchain. This transaction demonstrates how artificial scarcity, when it's guaranteed by an immutable, decentralized ledger, can create extraordinary value for completely intangible goods by totally redefining ownership and collectability.
That is the ultimate lesson of our entire deep dive, isn't it? Whether it's an ancient shell or a cryptographically hashed token, the economic value is fundamentally a social contract about scarcity. And it's enforced by either the state, the market, or now the code.
And this paradox of scarcity extends beyond just currencies or art. It influences critical infrastructure and societal trends. Our sources highlight several other critical scarcities in the digital economy that are driving economic opportunity and societal risk today.
Okay, let's start with a crucial human bottleneck, the scarcity of cybersecurity professionals.
Despite the proliferation of digital infrastructure and trillions of dollars spent on technology, the scarcity of skilled cybersecurity experts is massive. It's projected to be a shortfall of over 3.5 million globally by 2025. This engineered scarcity of expertise creates huge labor opportunities, but at the same time poses a massive systemic vulnerability for our critical digital infrastructure, from hospitals to financial systems.
There's also the profound scarcity of privacy and individual autonomy in the modern surveillance economy.
Absolutely. In these surveillance-driven, ad-based economies, companies monetize user data on a scale we've never seen before. This makes privacy a commodity that becomes increasingly scarce. We often pay for free services with our personal data. And while regulations like the EU's GDPR attempt to restore some autonomy, regulatory enforcement often lags way behind the technological advancements, ensuring privacy remains a scarce, monetized resource available primarily to those who can afford premium, ad-free services.
And finally, a scarcity that impacts the future of innovation itself, the scarcity of open source funding.
The irony here is rich. The entire digital economy, including massive commercial systems, is built on open source contributions, on free CodeMe. Yet major tech firms often fail to fund these critical ecosystems adequately. The 2014 Heartbleed vulnerability in OpenSSL, a widely used security library that operated on minimal funding, exposed how chronically under-resourced open source projects can compromise global cybersecurity. Value is concentrated in proprietary, closed systems, creating a deep and dangerous scarcity of funding for the very platforms that democratize technology.
That is a huge systemic risk we all rely upon without even realizing it. So we've traced value from the tangible anchor to the digital contract. What does this all mean for us, for the audience, as we navigate this high-speed, high-stakes digital economy? How do we apply this historical and technical insight?
Our deep dive provides 4 critical takeaways for anyone looking to understand the mechanics of wealth and value today. And these aren't just facts. They are lenses through which you can evaluate every economic decision, from investing to career planning.
Okay, number 1, evaluate the trust engine.
When you assess any currency or digital asset, from the US dollar to Bitcoin, or even tokens on a DeFi platform, you have to fundamentally shift your focus from the price to the foundation. You have to ask, who or what is the primary guarantor of value? Is it a government, a fiat system that's susceptible to political decisions and that disease of the heart? Is it a physical asset susceptible to dilution or scarcity manipulation? Or is it a decentralized network relying on cryptographic security and technological resilience? Your wealth stability depends entirely on the resilience of that underlying trust engine.
That's a crucial analytical shift. The second takeaway, one we saw throughout the digital economy section, is recognize engineered value.
Never confuse replicability with cheapness. In the digital economy, value is deliberately imposed through design. We saw this with video game scarcity and subscription models. You have to understand that subscription fees for necessary tools, paid verification badges like the blue checkmark on social media, and virtual land purchases in the metaverse derive their worth not from physical constraints, but from social scarcity or access scarcity. These restrictions are commercially strategic. You are paying to participate in an exclusive layer of a network, even if the underlying technology is infinite.
Third, we need to broaden our view of scarcity beyond just money and tokens. So, reflect on critical digital scarcities.
The scarcities that affect your daily life may not be monetary. We discussed the shortage of cybersecurity professionals, the scarcity of privacy due to data commodification, and the scarcity of open source funding. These critical bottlenecks impact your security, your autonomy, and the future viability of core digital infrastructure far more profoundly than the daily fluctuations of currency markets. Recognizing where the crucial, under-resourced bottlenecks lie gives you better insight into future risks and long-term opportunities.
And finally, a takeaway directly from that complex financial modeling we discussed earlier. A lesson applicable to almost any complex system. Remember, hysteresis.
If you lose trust, whether it's in a bank, a government system, a business partner, or even a professional relationship history, and our financial models show that regaining it requires disproportionately greater effort and a massive shift in conditions than it took to lose it. This concept of hysteresis means that preventing the loss of trust in the first place, through transparency and strong fundamentals, is always less costly than trying to recover it afterward. Maintain trust as if it were your most valuable, non-renewable asset.
So we've taken a deep dive spanning 4,500 years of human ingenuity, and we've seen that value isn't a fixed commodity, it's a moving target, constantly being redefined. From the permanence of a piece of gold to the scarcity programmed into a decentralized ledger.
And the stability of any wealth system relies entirely on managing scarcity and maintaining trust. When the scarcity is tangible, the system is brittle to dilution. When the trust is centralized in a government, it's vulnerable to political temptation and human error.
So we end with a final provocative thought for you. The digital age gives us the ability to engineer scarcity perfectly through code, as we saw with the fixed 21 million limit of Bitcoin, or through explicit access restriction like DRM. But if value is simply a collective agreement, what happens when we can engineer that collective agreement without the traditional checks and balances of governments or the physical constraint of gold? We are building consensus from scratch, defined by mathematics, and the implications of that radical freedom are still unfolding for your future wealth.
It remains the most fascinating question of our time.
If you want to dive deeper into the original source materials covering ancient Chinese currencies, Roman coins, the 2008 financial crisis models detailing hysteresis, and the technical specifics of proof of stake, you can find them all linked on our site. Thank you for joining us for the deep dive.